Hello everyone, my name is Bernie and welcome to my channel Bernie to the Rescue. Today's video is about how to get started investing in stocks for beginners. If you like the content and find it helpful, please like, comment, and subscribe to my channel, or simply share it with a friend or family member whom you love and may find it helpful. Thanks. Now let's get into the video. Getting started with stock investing as a beginner can seem overwhelming, but it doesn't have to be. Here are some steps you can follow. 1. Educate yourself. Before you start investing in stocks, it's important to understand the basics of the stock market and how it works. Read books, articles, and online resources to learn about different types of stocks, investment strategies, and the potential risks and rewards of investing in the stock market. 2. Assess your financial situation. Before investing in stocks, it's important to understand your financial situation, including your income, expenses, and savings. Consider your financial goals and risk tolerance when deciding how much money to invest in stocks. You can start with as little as $5 a day. 3. Open a brokerage account. To buy and sell stocks, you'll need to open a brokerage account with a reputable firm. Many online brokers offer commission-free trading, making it easier and more affordable for beginner investors to get started. 4. Choose your stocks. There are many different types of stocks to choose from, including individual stocks, exchange-traded funds, and mutual funds. Consider your investment goals, risk tolerance, and diversification strategy when selecting stocks. 5. Start small and diversify. As a beginner, it's important to start small and not put all your money into one stock. Diversifying your portfolio by investing in a mix of stocks, bonds, and other assets can help reduce your overall risk. 6. Monitor your investments. Regularly monitoring your investments and making adjustments as needed can help you stay on track towards your financial goals. It's also important to keep in mind that investing in the stock market carries a certain level of risk, and it's important to understand that your investments can go up and down in value. Make sure to consult a financial advisor if you have any questions or concerns. Investing in the stock market is important for several reasons. 1. Potential for higher returns. Historically, the stock market has provided higher returns over the long term than other investment options such as bonds, savings accounts, and money market funds. 2. Inflation protection. Investing in the stock market can help protect your wealth from the impact of inflation. As the cost of goods and services rises over time, investing in stocks can help your money grow at a pace that outpaces inflation. 3. Building wealth. Investing in the stock market can be a powerful way to build wealth over time. By investing regularly and holding onto your investments for the long term, you can potentially accumulate a substantial sum of money that can be used for a variety of financial goals, such as retirement, college education, or purchasing a home. 4. Diversification. Investing in the stock market allows you to diversify your portfolio, which can help reduce your overall risk. By investing in a mix of stocks, bonds, and other assets, you can potentially lower your risk and improve your chances of achieving your investment goals. 5. Professional management. By investing in mutual funds or exchange-traded funds, you can benefit from professional management and have access to a wide range of investment opportunities, including stocks, bonds, and other assets. It's important to keep in mind that investing in the stock market involves risk, and there is no guarantee of profit. However, over the long term, the stock market has provided investors with the potential for higher returns and has been an important tool for building wealth and preparing for the future. What are the different investment strategies? There are many investment strategies that individuals can use when investing in the stock market. Here are some of the most common. 1. Growth investing. This strategy focuses on investing in companies that are expected to grow at a faster rate than the overall market. Growth investors look for companies with high earnings growth, a strong balance sheet, and a solid management team. 2. Value investing. This strategy involves buying stocks that are undervalued by the market. Value investors look for companies with low price to earnings ratios, high dividend yields, and strong fundamentals. 3. Dividend investing. This strategy focuses on investing in companies that pay regular dividends to their shareholders. Dividend investors look for companies with a history of consistently paying dividends and a solid financial position. 4. Income investing. This strategy involves investing in high-yielding assets such as bonds, dividend-paying stocks, and real estate investment trusts to generate a steady stream of income. 5. Momentum investing. This strategy involves investing in stocks that have been performing well in the recent past, with the expectation that they will continue to perform well in the future. Momentum investors look for stocks that have shown a strong uptrend in price and volume. 6. Index investing. This strategy involves investing in a broad-based index fund that tracks a specific market index. such as the S&P 500. Index investing provides exposure to a wide range of stocks and can be a low-cost and convenient way for investors to diversify their portfolios. 7. Sector investing. This strategy involves investing in a specific sector of the market, such as technology, healthcare, or energy. Sector investing can be a way to capitalize on growth opportunities in specific industries. It's important to keep in mind that different investment strategies have different levels of risk and suitability for different types of investors. It's recommended to consult a financial advisor to help determine the best investment strategy for your individual needs and goals. What are some of the mistakes new investors make? Making mistakes is a natural part of the learning process, and investing in the stock market is no exception. Here are some common mistakes that new investors often make. 1. Not doing enough research. Investing without fully understanding a company or a stock can be a recipe for disaster. Before investing, it's important to research a company's financials, management, and industry to make an informed decision. 2. Chasing after hot stocks. Following the latest stock market trend or investing in a hot stock that everyone is talking about can be tempting, but it's often not a wise move. Hot stocks can be risky, and their prices can be overvalued and subject to rapid swings. 3. Timing the market. Trying to time the market by buying and selling stocks based on short-term predictions can be challenging and is often unsuccessful. The better approach is to adopt a long-term investment strategy and focus on building a well-diversified portfolio. 4. Investing too much too soon. New investors often make the mistake of investing too much too soon, putting all their money into one or two stocks. This can be a risky strategy and can lead to significant losses if the stock performs poorly. 5. Not diversifying. Diversifying your portfolio by investing in a mix of stocks, bonds, and other assets can help reduce your overall risk. Not diversifying your portfolio is a common mistake made by many new investors. 6. Relying on emotions. Investing based on emotions, such as fear or greed, can lead to impulsive buying and selling decisions. It's important to have a solid investment plan in place and to stick to it, even during times of market volatility. 7. Not having a plan. Having a clear investment plan and goals can help guide your decision making and keep you focused on your long-term objectives. Without a plan, it's easy to get distracted by short-term market movements and lose sight of your goals. It's important to keep in mind that investing in the stock market involves risk and there is no guarantee of profit. By avoiding these common mistakes and taking a disciplined approach to investing, you can help increase your chances of success over the long term. What do successful investors have in common? Successful investors often share several common characteristics that have helped them achieve their investment goals. Here are some of the traits that successful investors often have in common. 1. Patience. Successful investors understand that investing is a long-term game and are willing to wait for their investments to grow over time. They are not easily swayed by short-term market movements and have the discipline to stick to their investment plan. 2. Diversification. Successful investors understand the importance of diversifying their portfolios to reduce risk and help achieve their investment goals. They invest in a mix of stocks, bonds, and other assets and regularly review and adjust their portfolio to ensure it remains well diversified. 3. Self-education. Successful investors are always learning and seeking to expand their knowledge of the markets and investing. They understand that investing is not a one-time event, but rather a continuous process that requires ongoing education and research. 4. Disciplined approach. Successful investors have a clear investment plan and stick to it, even during times of market volatility. They are not swayed by emotions and make investment decisions based on a thorough understanding of the company and market conditions. 5. Risk management. Successful investors understand that investing involves risk and are prepared to accept some level of risk to achieve their investment goals. However, they also practice good risk management by diversifying their portfolios and avoiding impulsive investment decisions. 6. Long-term focus. Successful investors have a long-term investment horizon and are not focused solely on short-term gains. They understand that building wealth takes time and are willing to hold onto their investments for the long haul. 7. Flexibility. Successful investors are flexible and are willing to make changes to their investment strategy when necessary. They are not afraid to admit when they are wrong and are willing to make changes to their portfolio when market conditions change. It's important to keep in mind that investment success is not solely determined by these traits, and there are many other factors that can impact an investor's performance. However, incorporating these traits into your investment approach can help increase your chances of success over the long term. In conclusion, educate yourself. Open a brokerage account. You can start with as little as $5. It's important to invest so you can build financial wealth for you or your family. Avoid being an emotional investor and don't try timing the market, and be in the game for the long run with a plan. Successful investors are characterized by patience, diversification, self-education, a disciplined approach, good risk management, a long-term focus, and flexibility. They have a clear investment plan, stick to it, and are not swayed by emotions or short-term market movements. They understand that investing involves risk, but also practice good risk management and are willing to hold onto their investments for the long term. Successful investors are always seeking to expand their knowledge and are flexible in making changes to their investment strategy when necessary. If you have any tips that could help someone else get started in the stock market during this time, please share in the comments below. Thank you for watching.